In crypto markets, pin bar candlesticks flash across charts like lightning. Each long shadow tells a story of market panic and opportunity. When facing multiple pin bars, how do we scientifically identify which ones are truly worth buying the dip? How do we optimize entry timing based on volatility analysis? Today, we are sharing the QFL strategy, a systematic improvement to traditional pin bar methods based on volatility theory. Hello, everyone. Welcome to our quantitative strategy channel, where we focus on finding the most practical advanced strategies for crypto markets. In crypto markets, pin bar candlesticks appear frequently like lightning strikes. Each long lower shadow attracts bottom fishing capital. However, traditional pin bar strategies have left countless traders repeatedly frustrated in seemingly attractive opportunities. They either buy halfway down the mountain or fall into false breakout traps. The market desperately needs a scientific method to accurately identify genuine panic selling. The QFL strategy summarizes years of practical experience into this volatility-based pin bar method. This strategy no longer relies on visual observation of shadow lengths. Instead, it uses technical indicators like ATR to quantify market panic levels. It transforms subjective pattern recognition into objective data analysis, providing practical traders with a more scientific and systematic bottom fishing tool. This strategy systematically upgrades traditional pin bar approaches. The core flaw of traditional pin bar strategies lies in over-relying on candlestick patterns, while ignoring deeper market volatility characteristics and emotional states. This strategy achieves four major breakthrough innovations. First, compared to simple shadow line judgment, the strategy uses dual conditions to identify panic selling. It requires prices to break below dynamic base levels to confirm price anomalies. The system then cyclically checks multiple time windows for average volatility ranges and single candlestick amplitudes exceeding ATR thresholds to determine volatility anomalies, effectively filtering false breakouts. Second, it establishes dynamic base levels instead of fixed support levels, allowing buy points to adaptively adjust with market structure. Third, it designs intelligent rebound levels instead of fixed profit-taking ratios, dynamically setting exit levels based on current volatility characteristics. Finally, it builds a multi-dimensional position management system, including cooldown period controls and 3 differentiated profit-taking mechanisms. This quantitative design precisely locates genuine panic bottoms, effectively avoiding false pin traps, upgrading traditional pattern recognition to a scientific analysis system based on volatility and market structure. Parameter design reflects the strategy's transformation from experience-based judgment to statistical analysis. Base level multiplier determines by benchmarks through statistical characteristics of historical lowest prices. Rebound multiplier design is based on mean reversion theory, predicting rebound amplitude through statistical characteristics of current volatility ranges, achieving dynamic optimization of exit timing. Look-back period provides sufficient sample size for dynamic calculations, ensuring statistical result reliability. ATR period sets the volatility judgment cycle. ATR multiplier is the strategy's core innovation parameter. When volatility exceeds normal ATR levels by the set multiple, the market is considered to enter an abnormal state. This threshold directly affects the balance between strategy signal frequency and quality. Panic sell percentage sets a buffer zone for price breakout judgment, defining how far below the base level prices must fall to trigger genuine panic selling thresholds. Exit profit threshold completes the strategy framework from a profit confirmation perspective, ensuring trades have economic meaning. Only when profits reach the set threshold will exits be considered. Take profit option provides 3 profit-taking modes corresponding to different risk preferences. Range bars calculates local volatility ranges. Cooldown bars represents the cooling period, avoiding excessive concentrated investment within the same volatility cycle. The indicator calculation module transforms abstract market concepts into concrete mathematical models. Base level calculation uses moving minimum methods from time series analysis. The lowest close function gets historical lowest closing prices, then combines with multiplier factors to form a dynamic support system. The statistical significance of this design is that it is based on lower quantile characteristics of historical price distributions, providing probabilistically meaningful support zones. Using a 1-period lag avoids immediate impact of current prices on calculation results, ensuring signal stability and consistency. Rebound level calculation is based on local volatility characteristic analysis. Range last bars reflects current market volatility strength by calculating recent price ranges. The theoretical basis of this design is volatility clustering effects. Price rebounds during high volatility periods often have larger amplitudes by adding local volatility ranges to base levels. The strategy achieves adaptive adjustment of exit targets. The ATR indicator serves as a standardized volatility measurement tool, providing statistical benchmarks for anomaly detection. Signal generation mechanisms reflect the conversion from qualitative to quantitative analysis. Traditional pin bar strategies rely on visually identifying long lower shadows, while this strategy achieves automated identification of volatility and price anomalies through algorithms. The volatility anomaly algorithm designs dual-layer detection logic. The first layer identifies cumulative anomalies through average volatility detection. When average volatility over continuous time periods exceeds ATR thresholds, it indicates the market is experiencing sustained abnormal conditions. The second layer captures sudden anomalies through single-period volatility detection, identifying dramatic volatility within individual time cycles. The statistical significance of this dual mechanism is that it can identify both gradual market panic processes and capture sudden panic events. Panic sell percentage sets safety margins for price breakout confirmation, ensuring only when prices truly break below base levels and reach lower thresholds are they confirmed as valid panic selling. The is panic sell condition requires simultaneous satisfaction of price breakouts and volatility anomalies. This combination verification improves signal statistical significance. Rebound signals as rebound are based on dynamic threshold judgments, avoiding limitations of fixed profit-taking ratios. The entire signal generation process reflects multi-indicator verification methodology in modern technical analysis, improving signal quality through combinations of conditions across different dimensions. QFL strategy entry logic is based on panic selling identification and time diversification principles. First, the strategy initializes key trading record variables, including last entry bar index and position management arrays, laying the foundation for subsequent refined management. Precise position information recording is achieved through entry price arrays and position size arrays. Each trade's entry price and position size are independently tracked, supporting flexible exit strategy choices. Entry conditions require simultaneous satisfaction of two core requirements. First is panic selling signal confirmation, where prices break below base levels accompanied by abnormal volatility. Second is cooldown period verification, ensuring at least the set number of bars have elapsed since the last buy. The strategy uses cooldown mechanisms to avoid repeated buying within the same volatility cycle. This is because multiple signals within short periods often originate from the same market panic event, lacking statistical independence. This dual verification mechanism effectively avoids consecutive bottom fishing traps common in traditional pin bar strategies. When entry conditions are met, the strategy executes buy operations and simultaneously updates trading records. The system records the current bar index as the last entry position, while storing entry price and position information in corresponding arrays, providing data support for subsequent batch profit-taking management. The strategy adopts a gradual position-building approach, buying fixed positions each time conditions are met. This diversifies the risk of single judgment errors through multiple small investments and ensures timely notification of key trading opportunities through alert systems. QFL strategy exit logic embodies the essence of modern portfolio management, achieving risk-controlled profit locking through multi-level condition verification and flexible profit-taking modes. Profit-taking decisions are based on dual confirmation mechanisms. They require both reaching minimum profit thresholds to ensure economic significance of trades and technical confirmation of rebound signals to avoid premature exits in market noise. This combination verification significantly improves exit timing accuracy. The strategy provides three differentiated profit-taking modes to suit different risk preferences. Average price mode makes unified decisions based on overall portfolio performance, suitable for investors pursuing long-term return maximization. First, entry mode adopts conservative in first-out strategies, prioritizing protection of early investment returns and reducing time risk. Independent position mode achieves the most refined risk management. Each investment is independently evaluated and decided upon. When a certain position reaches profit-taking conditions, that portion is immediately closed, while other positions continue holding, waiting for better exit opportunities. This layered management mode maximizes strategy adaptability and profit potential. The visualization system intuitively presents key strategy indicators, facilitating real-time monitoring and analysis verification. Dynamic display of base-level lines and rebound-level lines reflects the strategy's adaptive characteristics compared to traditional fixed-level lines. It better reflects genuine market structural changes. The alert system ensures timely notification of key trading opportunities, supporting the strategy's live trading application needs. The QFL strategy shows differentiated applicability across various market environments through its ATR volatility anomaly detection mechanism. In highly volatile market environments, panic selling occurs frequently with large volatility amplitudes. The strategy's ATR anomaly detection can precisely capture oversold rebound opportunities. Compared to traditional simple pin bar methods, it significantly improves signal effectiveness and profit probability. In sideways markets, although pin bar candlesticks are numerous, the strategy's multiple verification mechanisms effectively filter noise signals generated by technical adjustments. It focuses on genuinely statistically significant abnormal selling events, avoiding frequent stop losses in normal fluctuations. In strongly trending markets, dramatic price movements also produce deep pullbacks and panic selling. The strategy can effectively identify these rebound opportunities within trends. Different asset class applications require differentiated parameter calibration. For highly volatile small cap coins, consider moderately increasing ATR multiplier thresholds to reduce noise interference. For large cap coins, thresholds can be lowered to improve signal sensitivity. Practical application requires flexible adjustment of parameters and profit-taking modes based on market environments. For example, in high volatility environments, more conservative profit-taking strategies can be chosen. Meanwhile, reasonable position addition limits should be set based on capital scale to avoid excessive risk concentration. Advanced applications suggest reasonably determining single order quantities and overall position limits based on capital management principles to achieve effective risk control, combined with volatility index type indicators to judge macro market sentiment states. When panic emotions reach extreme values, it is often when the strategy achieves maximum effectiveness. Multidimensional analysis enhances the strategy's practical effectiveness. From a systematic perspective, the QFL strategy shows different strengths and weaknesses across multiple dimensions. In terms of strategy completeness, it builds a complete framework from signal identification to execution management, ATR volatility detection, dynamic level calculations, and multiple profit-taking modes form a relatively comprehensive trading system. In risk management dimensions, cooldown period mechanisms avoid excessive concentrated buying. Multiple verification conditions improve signal reliability. Particularly, the multi-layer profit-taking design achieves good risk management. The combination of gradual position building and flexible exits makes it a practical weapon. Adaptability analysis shows dynamic parameter design enables the strategy to adapt well to different market environments, with clear advantages over traditional fixed threshold methods. In terms of understandability, the strategy logic is clear with solid theoretical foundations. Although implementation is relatively complex, core concepts are easy to grasp. Innovation is reflected in transforming subjective pattern recognition into objective statistical analysis, introducing modern volatility theory to reform traditional pin bar strategies with significant methodological innovation. Practicality evaluation shows it can significantly improve traditional strategy performance under reasonable parameter configurations. Overall, this strategy provides beneficial exploration for scientific improvement of traditional pin bar strategies, offering borrowable ideas and methods for similar technical analysis strategy optimization.